Titans of Wall Street, introducing Vanguard and BlackRock, Vanguard and BlackRock. These names might not be on everyone's lips, but they hold immense power. They are the financial giants shaping the global economy. We're talking trillions of dollars under management. That's more money than most countries' GDPs. These firms have a huge influence on the stock market. Their decisions affect pensions, savings and investments. But what do they actually do, and should we be concerned about their power? Vanguard and BlackRock are asset management firms. They invest money on behalf of individuals and institutions, but their reach extends far beyond Wall Street. They have a say in nearly every major corporation on the planet. This level of influence demands scrutiny. Are Vanguard and BlackRock forces for good, or are they concentrating too much power in the hands of a few? Let's dive in and find out. The business of money asset management explained. Imagine a giant pool of money. That's what asset management firms like Vanguard and BlackRock manage. They take money from investors, pool it together, and then invest it in various assets. These assets can include stocks, bonds, real estate, and more. The goal is to grow the pool of money over time. This generates returns for the investors who entrusted their money to the firm. Asset managers charge fees for their services. These fees are typically a percentage of the assets they manage. Vanguard and BlackRock are the two largest asset managers in the world. They manage trillions of dollars for millions of investors worldwide. Their size and scale give them unparalleled influence in the financial markets. But this influence isn't limited to Wall Street. Because they own so much stock in so many companies, Vanguard and BlackRock have a say in how those companies are run. This power dynamic raises important questions about corporate governance and accountability. The Vanguard Way, indexing the world. Founded by John Bogle in 1975, Vanguard revolutionized investing with index funds. Bogle believed that trying to beat the market was a fool's game. Instead, he advocated for a simpler, low-cost approach, investing in index funds that track a specific market index, like the S&P 500. An index fund is like a basket of stocks. When you buy an index fund, you're buying a tiny piece of all the companies in that index. Index funds are popular because they are a low-cost and diversified way to invest in the stock market. Vanguard is structured as a mutual company, which means it is owned by its investors. This structure aligns Vanguard's interests with those of its clients. They make money when their investors make money. This customer-centric approach has been central to Vanguard's success. Section 4. BlackRock's Aladdin technology fuels dominance. BlackRock, founded in 1988, took a different path to dominance. While Vanguard focused on index funds, BlackRock embraced technology. Their secret weapon, Aladdin, a sophisticated risk management and trading platform. Aladdin stands for Asset, Liability and Debt and Derivative Investment Network. It's used by BlackRock and many other financial institutions to manage risk and make investment decisions. Aladdin gives BlackRock a technological edge, allowing them to analyze massive amounts of data and identify investment opportunities. BlackRock's rise has been meteoric. They have benefited from the growth of exchange-traded funds, or ETFs, which are similar to index funds but trade on stock exchanges. BlackRock is the world's largest ETF provider with its iShares ETF family. Section 5. Too big to fail? The power and controversy of Vanguard and BlackRock. Together, Vanguard and BlackRock have become titans of finance. They are the largest shareholders in many of the world's largest companies. This concentration of ownership raises concerns about their influence on corporate behavior and the global economy. Critics argue that Vanguard and BlackRock's dominance stifles competition and innovation. They worry that these firms have too much say in how companies are run. Some even argue that they pose a systemic risk to the financial system. Others counter that Vanguard and BlackRock are passive investors. They don't get involved in the day-to-day operations of the companies they invest in. They argue that their size and scale benefit investors by driving down costs and increasing market efficiency. The debate over Vanguard and BlackRock's power is complex. There are valid arguments on both sides. One thing is certain: their influence is undeniable, and their actions have far-reaching consequences.